Welcome to the Cash Flow Crew. Congratulations and thank you for taking this first step towards achieving financial freedom. I am on a mission to help 3.3 million people break free from the rat race using cash flow assets, and you are part of the crew that's going to help make that happen. I'm going to jump into some special bonus training right now in this video to help you shortcut the process and get started faster than everyone else. Real quick, in the next 15 to 20 minutes, you're going to receive an email with your login information to access the private members area, so you can access Blackwell University bonus content right away. Now, let's jump into the bonus training. First things first, in week 2 of the Blackwell workshop, we talk about getting your money right. Folks have challenges with this homework during the week because it requires them to get serious about organizing their money. Now here's how you can shortcut the process. Grab a piece of paper and something to write with. Pull together your 2 most recent months of bank statements for all of your accounts. Then, pull together your 2 most recent months of pay stubs. Now, you need your 2 most recent years of tax returns. Also, pull together any current statements for retirement or investment accounts. Keep all of this information current during the workshop. We'll call this your financial dossier. You'll need this information to narrow down pricing and financing options when we start looking at properties. So the more organized you are, the better. Next, everyone wants to understand the math behind analyzing properties. I'm going to unpack that right now, and it's simpler than most people think. We analyze potential properties based on 4 key factors: cash flow, appreciation, depreciation, and debt reduction. Let's talk about those real quick. Cash flow is pretty simple. You take the total amount of rent that you collect each month, and then you just subtract out all of your expenses. Now, when you're subtracting out a mortgage, make sure to include your principal, your interest, your taxes, and your insurance. Okay, your PITI. Then you're also going to take out any maintenance or management costs. Easy enough? The amount that's left over is your positive cash flow. And the way to math that and figure out what your returns are, multiply that number times 12 so you get an annual projection and divide that into the down payment that you put down on the property. There's your return on investment as a percentage. Easy enough? Appreciation is also pretty simple. Appreciation is the amount of value that the property goes up year over year. This is actual money that is sitting in the property. In case of emergency, break glass, right? So let's say you buy a property for $100,000 and it goes up to $105,000 over the next year. Well, you made $5,000 in actual value in the property. That's appreciation. You would take that projected increase and divide that into your down payment on the property. Now you have a percentage return for your appreciation. Debt reduction, I'm going to skip over depreciation real quick. Debt reduction is the amount of mortgage principal that gets paid off over the course of a year. Your tenants pay you rent. You use that rent to pay the mortgage, right? Well, with a 30-year amortized mortgage, and we always buy with a 30-year amortized mortgage, each month you pay some interest and a little bit of principal. And each month you pay a little bit more principal and a little bit less interest over 360 months. Well, what you do is you use an amortization calculator to figure out how much principal is paid off over the first year. Total that up and divide that into the amount that you put down on the property. Now you have the percentage return for debt reduction. Depreciation isn't a direct return, it's a tax benefit. Here's how it works. The IRS allows you to account for the reduced value of a property over a period of time. For a residential property, it's 27.5 years. Why 27.5? Actuaries are smarter than us, and they told the IRS how to write the code. But what you're going to do is look at the property tax statement for the property you're looking at. what you're going to do is look at the property tax statement for the property you're analyzing. On that statement, there are two values. There's a land value, that is literally the dirt under the property, and then there's a structure or an improvement value. That's the one we're going to focus on. Take that structure value and divide it by 27.5. Now, how that's applied in practical application is that number is typically about the same or a little bit more than the net positive cash flow on the property. So the practical application of your depreciation is you shouldn't have to pay income tax on your cash flow. Now, make sure that you talk to a CPA about this because not everyone can depreciate, and it's a little different depending on your specific situation. But don't worry, I'll give you some tools during the workshop to help you with all of this. Third, everyone wants to start looking at properties right away, but they don't know where to start. So here's some places to help you out. First, your very first property, your first cash flow asset should be close to home. No more than a 1-hour drive from where you live. Pick an area near you that meets the 3 rules of real estate. What are the 3 rules of real estate? Location, location, and location. First, the location must be an area where people want to live. They need to feel safe. Second, the location must be an area where there are jobs nearby. Third, the location must be in an area where there's economic growth, i.e. property values need to be going up. Take a look at on-market properties. What's that mean? It means you need to establish a relationship with a local real estate agent who has some market knowledge. Listen, every real estate agent is going to tell you that they can help you buy a rental, all right? But very few actually understand how to analyze and locate good cash flow assets. The Blackwell Workshop is designed to equip you with the skills and tools you need to analyze properties. So what you need is a relationship with a good real estate agent who can help you search for your target properties. Ask this real estate agent to send you a list of all the available homes in the neighborhood or zip code that you're looking in. Don't overwhelm yourself here, but get a list of properties based on bedrooms, bathrooms, square footage, and price. Next, ask them for a rental analysis that shows what rent rates are in the area. You can also look online at Zillow or Rentometer to get a good feel for what average rents are in the area. Typically, rent rates are figured based on square footage. So if rents are $1,500 for a 1,500 square foot house, rents would be $1 per square foot. Easy enough? Use those figures to math this out. Okay, let's do one for real, just to illustrate. I went on to Zillow and did a quick search for houses that look like they would meet my criteria for a basic rental. Easy enough. This is one that I found. I like the purchase price, $235,000. Looks very, very affordable in my area. I know where this property is located because I know my local market, and I know that rents in this area are about $1.40 per square foot. It's a 3-bedroom, 1-bathroom house, 1,016 square feet, so $1.40 would mean that I could rent this house out for around $1,400 a month. How does that work out? Well, we know that our purchase price is going to be $235,000. If we put down 10% of the purchase price, that's $23,500. Now let's assume that we are taking out a 30-year mortgage at 4%. So your mortgage amount is going to be $211,500. At 4% over 30 years, you have a monthly principal and interest payment of $1,009.73. The property taxes on this property are $1,912 a year. Now, insurance rates vary market to market. I'm going to assume around $800 a year for this property, for property insurance. Take that taxes and that insurance number, put them together and divide it by 12. And what you do is you end up with $226 a month for taxes and insurance. That means that your total monthly expense on this property is $1,235.73. Now remember, we said that we were going to make $1,400 a month in projected rent on this property. So So you take your $1,400 a month, subtract the $1,235.73, and that leaves you $164.27 in positive cash flow. I'm going to take a note here and just say, if you don't project positive cash flow, you're not going to buy the property. We only buy properties that cash flow positive. Let's take that $164.27 and multiply it times 12. That gives us our first year return of $1,971.24. When you divide that $1,971.24 into the $23,500 that you put down on the property, you get a return of 8.39%. Easy enough? Let's talk about debt reduction. On a amortization schedule, over the first year, there is $3,724.55 in principal reduction paid off by the tenants just making the mortgage payment for you. That $3,700 divided into your $23,500 that you put down on the property is a 15.85% return. Not bad. Appreciation. We're going to estimate that the property is going to increase in value by about 3% over the first year. That means that we're looking at a $7,050 increase in property value over the first year. That is real money. It's just sitting there in your property. And because you don't realize that gain, you don't have to pay taxes on it. So $7,050 divided by your $23,500 is a 30% return on your investment. Depreciation, when we're looking at the value of the property, we're making an estimation here that $8,500 is depreciable. That $8,500 is greater than your net cash flow. So for most folks, they shouldn't have to pay income tax on the property, on this property as a rental. Let's total these up. If you had 8.39% return from your cash flow, 15.85% returns on your debt reduction, and 30% returns on your appreciation, this property is projected to return 54.24% based on your down payment in the first year alone. Compare that to what you would get with any other investment account, and you'll start to see how this makes sense. When you apply this math to any random property that you find online, you're able to start analyzing and narrow down on properties that might make sense to look at a little bit closer. Obviously, we need to verify all this information, and I will show you how to do that during the workshop. But now you have some basic tools to math out and see if these make sense. Listen, the Blackwell workshop you just bought is everything you need to get to your $10,000 per month or more goal. But if you want to cut in line and get to the next level even faster, you may want to consider attending the Blackwell Bootcamp or joining the Blackwell Club Mastermind. The Bootcamp is a 3-day event where we unpack the pillars of the workshop, then break out into small groups to apply them in real time. My team is present to help you absolutely crush your goals. We also invite special presenters to the boot camps to discuss advanced cash flow tactics. Attendees will have access to off-market opportunities in multiple places across the United States. The goal is for everyone who attends the boot camp to leave with a property under contract, or at least have a short list of properties they're going to pursue once they get home. Blackwell Club is a private mastermind group that is focused on helping the members build and scale their cash flow asset portfolios with ongoing support and collaboration. All members of the club must be active real estate investors who meet very specific income minimums. The Blackwell Club meets online each month and once per year in an amazing location. Space is limited for both the boot camp and the Blackwell Club, so that both opportunities are available by application only. Our team will reach out to interested applicants to verify they are a good fit for the crew. To apply for either the boot camp or Blackwell Club, simply click the Apply Now button at the bottom of this page. Finally, make sure to jump into the Blackwell University and start the bonus training that you have access to while you're waiting for live sessions to begin. I look forward to helping you build cash flow assets and achieve financial freedom for yourself and your family.